Brian, we spent a good amount of time talking in the morning here about certain speculative parts of this market. I reminisce a bit about the mid to late 90s. It was a fun time, by the way. Just curious as to whether you see it and how you see it and whether it's a risk.
It's a very, very speculative market right now, and maybe that description needs a few more varies. It is the most speculative I've seen, certainly, since late 1999, early 2000. And, if you remember back to that point in time, it wasn't like the market softly rolled over and you could kind of start to think about some of your more aggressive positions. It just topped out one day. And I think that's probably what's going to happen here.
So how do you position for that? And what do you, again, to your point, I remember that period as well. And there isn't one thing that I could point to or, oh, that was it. It's any number of different things you can look at in hindsight. But what are you focused on to sort of try to determine? And how are you constructing your portfolio to make sure you're not hurt if, in fact, you're correct?
Well, we're a relative value manager, so we're very unlikely to find ourselves in the speculative end of the swimming pool under any set of circumstances. Right now, if you look at what's working in the market, it's almost like a smile with really speculative stuff and what you'd call the hope trade, so super deep value, very ultra contrarian type of stocks like department stores and things. Those have been doing well. We're not really in either of those places. We're more down the middle of the fairway, so quality businesses that can grow predictably, generate good cash flow. You don't need to use your imagination with respect to the accounting. And that tends to be rewarded, just not really, flavor of the month right now.
What's the bond market telling us? And how closely, how seriously you're watching this move in, say, the 10-year yield right now? I mean, are you in this camp that is debating the possibility of inflation and what that could potentially mean even before the year is out for Fed policy?
There's a complicated answer to that question that could take forever to explain, but yields matter. Okay, they definitely matter. And if you look at what happened in the year 2000, the Fed tightened up liquidity after Y2K proved to be a complete non-event. That's what ultimately took the speculative market down. So Y2K is not ever going to really repeat itself again. But what we do have is a reopening of the economy. And that's, it's contingent on vaccines. I saw yesterday that the administration raised guidance for 13.5 million vaccines a week. That sounds like 50 million a month. And we're going to get J&J probably at the beginning of March. That'll probably take the numbers closer to 80 million a month. There's only about 270 million American adults. So, if you kind of add that all together, that sounds like you get pretty close to everybody vaccinated by early to mid-May. And at that point, things are going to start looking a lot different. We just have so much pent-up demand, pent-up supply, pent-up liquidity looking for things to do. That seems like it could create some inflation. I think that's what the bond market is sniffing out.
Shepard Smith here. Thanks for watching CNBC on YouTube.